Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
Hey everybody, Brian Foucher, and welcome to Take Back Control Tuesday. Now, this is going to be a fun presentation. Some of you may have seen this before. Some of you, this might be the first time you're seeing this. And what we're going to be talking about is control. Now, obviously, take back control kind of gives that away, but one thing I want to talk about really quickly before we dive into the actual presentation is control. Because as I've gone through my own journey, my own education, a lot of hard life lessons, I've really understood one thing that's very powerful, and that is control. But control of what? Well, there's three things that I look at, that I always look at when it comes to control. And if you guys want to, put those in the chat box, you guys may have heard this before. But what are some of those things that we want to control in life? There's three things I look at. One is time. Time is a big one, right? Because we're so used to trading time for money, so we feel like we need to get control of our time. The other one is money. Money's a big one, right? That's what we're going to be talking about a lot about here today is control of money. But there's a third one. There's a third thing that we want to control, and that's our mind or our mindset. And so if you want to control time and money, what do you need to control first? Well, here's the thing. You've got to control your mindset first, because if you don't have control of your mindset, somebody else is going to control it for you. Okay? If you don't control your money, somebody else is going to control it for you. If you don't control your time, somebody else is going to take it from you and use it because it is very valuable. So the first thing I look at, though, is mindset. Because if you can't control your mindset, you can't control money. If you can't control your mind and money, you can't control time. So one of the first things we're going to dive into on this presentation is really around the mindset around the infinite banking concept. Because you do have to sort of change the mindset around money before you can get into infinite banking. Now, also, as we get into this presentation, we're going to be sharing with you, this very little known but very powerful wealth building strategy, but it can completely change your financial future. So we're going to be talking about your wealth. We're going to go ahead and talk about how you can live like the wealthy using one of their own techniques. And we're going to cover how you can keep control of your money today, but also for the next generation and generations to come, because that's really how you build wealth, is keeping that money in your family. Also, we're going to be talking about how to recycle and recapture the money that you make right now by paying off debts, by recycling the money back into your control. Once again, control, right? So as we go through this, any questions, guys, go ahead and use that chat box. Go ahead and use the Q&A box right there as well. We got Steve and some other people here that can answer questions for you. But let's go ahead and dive on into it. So I want to share with you a quote. Now, all of us here at the Money Multiplier, we like this quote for some obvious reasons, but the quote is by Will Rogers, and it says, "The problem in America isn't so much what people don't know, it's what people think they know that just ain't so." What's that mean? It means that we are programmed to think, remember mindset, to think certain ways about money that are not true. We've been taught something about money or the way that it works, but it's not true. So I'm going to be challenging the way that you think about money, the way that you've been taught about money. Okay, so I want you to keep an open mind as we go through this. That's why we want to use chat boxes, things like that. Okay. All right. Now, this is a pretty cool stat that when I first heard it, I didn't believe it. Right, mindset. Right, but here it is. If you take 118-year-old kids, 18-year-old kids, and you put them in a room and you ask every single last one of them where they'll be when they retire, what do you think they're going to say? Well, they're going to say, I'm going to be successful. I'm going to be a millionaire. I'm going to have all this money. I'll be free, all this kind of stuff. But here's the truth of it. When you fast forward to retirement age, out of those 100 kids, only 5% are going to be financially secure. That's crazy. At retirement age, only 5. How is it that we live in one of the wealthiest countries in the world, full of opportunities, but only 5 out of 100 people are financially secure at the time of retirement age, right? Why? Well, it's because we've been taught lies about how money works, about what to do with our money. So once again, keep an open mind, because let me ask you a question real quick. Give me one in the chat box if you want to be one of the 5. If you want to be one of those 5%, which, by the way, if you're here on this presentation, I'm assuming you want to be one of those 5, right? So give me a one in the chat box. There we go. Scott, Derek, Abigail, Anne-Marie. Awesome. Troy, yeah. Awesome. Yes. Yeah. We want to be one of those 5. But yet we work so hard for our entire lives, and yet most of us are not going to be one of those 5, right? And Michael Long, it's retirement age. So, 65, something like that, right? Most of us want to retire when we're 50, right? But yeah, it's pretty crazy. So we want to be one of those 5%. Now, the other interesting thing is that stat that I just said, it comes straight from the Social Security Administration. Like, it's not something I just make up, right? It actually comes straight from the Social Security Administration. 5 out of 100 people will be financially secure at retirement age. So what we're going to be talking about is a strategy that can allow you to be one of those 5, to have that generational wealth, but also to recapture the banking functions in your life. Okay. Now, I'm not going to go through a bunch about me and all that kind of stuff. You're not here to hear about me, but also, here's some of my background. So I did go to college. I went to Washington State University, go Cougs. I got a degree in construction management and did that for many, many years. Then I got into other things, but I went through my life the traditional way. I call it the hard way, by the way. And so what is that hard way? You guys might be doing the same thing, or you can relate to this. So I was raised lower class. My family, I remember we used to have to get up in the mornings. It was like freezing outside, go build a wood fire to, create heat in the mornings before we go to school. But that's how I was raised. I was told, though, to follow that traditional path. Go to school, right? Get good grades, get a degree, save into a 401k once you get that job out there in I guess call it middle America. And that's what I did. And then I got the house, right, with the mortgage. I got the growing family, all of those things that I was told to go do. The American dream, right? The white picket fence, all that kind of stuff. But I'll tell you, it did not feel like the American dream to me. Eventually, it felt like a financial nightmare, because here's what happened. I read this magazine, a financial magazine, in a doctor's office, and it said that the average millionaire knows their net worth, but the middle class individual, lower income people don't know their net worth. And I realized, well, I didn't know my net worth. So I went, that's the actual paper right there I did it on. I've lost it since then, but I got a picture of it. But I went and did the math. I was worth a negative amount of money after working over 10 years in corporate America. That did not sound like a very good path. When I did the math moving forward, I'd be worth less and less because the debt was just snowballing. So I was like, what the heck's going on? And so I realized I had to do something different, but I didn't know what to do different because my mindset, my financial literacy wasn't there. I didn't have that. And then something happened that really kind of really kicked my butt into gear. My grandfather, he was my idol, right? We always have those people we look up to in life. And he was a football coach and a coach at the local high school that I went to and my dad went to. He was known by everybody, worked his butt off for, man, so many years. And then he retired in his 60s and is going to go live the good life, right? He's going to go travel around with his wife, my grandmother, and go to his grandkids' football games and soccer games and all that kind of stuff. But that's not what happened. He got pretty sick. He had Parkinson's and some other things, ended up passing away without really ever enjoying his retirement. And that was just like, I was like, wait a second. My grandfather, who I looked up to, worked all these years because he was so looking forward to retirement and never got to enjoy it. So I was like, wait a second. I've got to do something today, something now, because I don't want that to be my story. Okay. So that's one of the things that really kind of got me going. And Obviously, anybody can say anything on the internet about how successful we are, all that kind of stuff. But this is one of the businesses. So I got into real estate, I got into e-commerce and some other businesses, financial literacy, and had some success in that space, and really kind of opened my eyes up to what was possible. And so this is one of my businesses back in, I think this is 2021, something like that. But this was a multiple seven-figure business, done over $30 million in revenue over the years. And so I got into a different space, a different world, and it allowed me to do a lot of fun things in my life. And I built a life where I can do what I want to do wherever I'm at. I've done this presentation I'm doing with you right now in a motorhome while traveling with my family. I've done it while at my family's cabin up in Alaska, done it all over the place. But I've been able to do a lot of fun things. And I really found my purpose in life, which is to free myself and others in order to live and heal. That is my purpose statement that has deep meaning for me, but that's the life that I live today. It's also allowed me to go and teach the things that I learned too. That's what I get a big kick out of. It's why I'm here right now. I like to take what I'm learning and share it with others because that's part of my purpose in life. And having purpose, by the way, is probably one of the best things to find in life, by the way. Okay. All right. So here's what I want you to understand, that what we're going to be talking about here today, this concept is not new. This is not a new thing. It's been around for a very long time. We're talking hundreds of years. But here's the thing. Who's talking about it? Who's doing it? Well, you ever heard of Robert Kiyosaki? Well, he actually talks about it in his book, Second Chance. Maybe Tony Robbins. He talks about it in his book, Money Mastered the Game. Also, this book right here, I have it sitting right here on my desk, always. This is Becoming Your Own Banker by R. Nelson and Nash, that really popularized this concept, how to become your own bank through infinite banking. By the way, I recommend these books. I recommend reading these books. Mapping Out the Millionaire Mystery. This is by Brent Kessler and Chris Naugle. They're my mentors as well. And so they wrote the book that really goes into this concept in a really simple manner. And then, of course, the Private Money Guide, which Chris Naugle wrote as well. So I recommend reading these books if you guys want to take a snapshot of this or go watch the recording. Definitely some good books to read or study when it comes to this concept. Okay. Now, there's lots of other people talking about this, but yeah, this is something that is known at that higher level. Okay. Now, also, who has used this strategy throughout history? Now, this is pretty interesting. So this concept is used by a lot of people. So you ever heard of Jim Harbaugh or Harbaugh? So he actually used this, or the college that he was working with, they used this concept for him for his bonus and his salary. And so they use it in a very strategic way. It's a pretty cool story. You ever heard of this guy? His name's Joe. I kind of forget his last name. Biden. Ever heard of that guy? He actually holds 6 of these policies. I wonder why. Well, by the way, they're private and they're protected. So we'll get into that in a little bit. Disneyland. So Walt Disney, he wanted to start Disneyland back in I think it was the 20s or 30s. Couldn't get any financing. So he used this concept to fund the start of Disneyland. Additionally, McDonald's. This is a really cool story. So Ray Kroc, when he took over McDonald's, opened up the first one and kind of bought it out from the brothers, or kind of bought it from underneath them. He used cash value life insurance, infinite banking, to run McDonald's for the first 8 years before it got profitable. So pretty cool. He was his own bank. The Pampered Chef, $3,000 from her policy, from her infinite banking policy, to start Pampered Chef. That thing is now like what, $1.5 billion in revenue. I mean, that thing is crazy. Also, wealthy families, the JP Morgans, or the JPs, the Morgans, the Chases, Vanderbilts, Rockefellers, all of these people have used this concept, and you can use it as well. Okay. So what will infinite banking do for you? So what can it do? So a couple things. So one, it creates guaranteed a generational wealth day one. That is very important. If you care about the next generation, if you care about making sure that those that you love are taken care of, right? This does that day one when you have this in place, not year 40, not 10, 20, 30 years down the road, but day one, those around you are protected and safe, okay? It allows your money to grow uninterrupted, compounded for the rest of your life, guaranteed. That's very, very powerful right there. Uninterrupted compound interest for the rest of your life with guarantees, right? These are very, very powerful concepts. It allows you to take control of your money away from the big banks, Wall Street, and puts that control back in your hands. Remember when I talked about control at the beginning of the presentation, right? We want to control our mind, our money, and our time. Well, this allows you to control your money, but it takes it away from the banks and Wall Street, because when you give control to them, who's making money? Well, mainly they are, right? But they're using your money to do it. In this case, You're making money off your own money. It also protects your money from lawsuits, from bankruptcy, divorce, and creditors and court orders in most states, by the way. So there's not a lot of vehicles that do that. This one does it. It is protected. It allows you to be the bank for things that you may normally use a bank for. Things such as real estate, investing, college, cars, homes, other types of investments, retirement, all while still having the benefits listed above. So let me ask you guys a question. Do you want to have all of these benefits in your life? Give me a one in the chat box if you want to have all of these things. So be the bank for all these things while at the same time having all of these things in place. Okay. Yes, there one Thomas right there. Yeah, Michael. Yeah, absolutely. All of these benefits, most strategies or concepts give you one or the other, not all of them. Okay. That's why this is so cool and why it's so powerful. All right, so I do recommend taking out a pen and paper. I know a lot of people don't write anymore. They're usually doing the digital stuff. But if you want, use the question box, use the chat box, ask questions as we go through this. And of course, I'm going to give you my information as well at the end of this so that you can ask me questions personally and directly, because there is nothing, by the way, to purchase on this presentation, nothing to buy. But you can also reach out directly to me. So we'll go through that. Okay. Now, I want to kind of talk about the mindset really quickly, because I talked about how mindset is very powerful. But in order to understand this concept, you have to understand your mindset a little bit as well. So let me ask you a question. Who learns the quickest? Kids. Like, kids learn so quickly. Now, you probably learned how to ride a bicycle when you were very little. And here's the thing. Even if you haven't ridden a bike in many years, it would not take you very long to ride that bike again. It's easy, right? You hop on the bike, you push the pedals, you go forward, you move the handlebars to the right, you go right, left, you go left. Okay, makes sense. Now, what would happen if your bike did not work that way anymore? What would happen if you turned the handlebars to the right and the bike went to the left? So after this presentation, by the way, if you want to, Google the term backwards bicycle, okay? It's a hilarious video because it shows this backwards bicycle where you turn the handlebars to the left and it goes to the right. The guy gets on to go ride the bike and he immediately falls right over. And it takes him around, I think it's around 6 months to ride the bicycle, the backwards bicycle. Now, here's the fun thing about that. Once he learns how to ride the backwards bicycle, he goes to hop on a regular bicycle and he can't ride that anymore. He can't ride the regular anymore because he learned how to ride the backwards one. So here's the thing. What we're going to be talking about is the backwards bicycle. That's infinite banking, okay? Because if you're thinking traditionally about money and how it works, we want to change our mindset. So keep an open mind, because once you learn how the backwards bicycle works or how infinite banking works, it's going to be very, very hard for you to go back to the regular way of thinking about money or the regular bicycle. That makes sense? So kind of a cool video, but a great analogy of how this works. Okay. Now, this is a question that I think is very important, because when you think about the slide that I showed at the beginning, where only five out of 100, 5% of people are financially secure in retirement, why aren't more people successful? Like, why? Okay. So the mysteries of money. So wealth killers. Now, when you follow that traditional path, like I was, these are the wealth killers. Taxes. I like paying taxes, but I love paying less more, right? I don't mind paying them, but I want to pay a lot less. Okay. But they definitely steal wealth. And so if you look at the tax code, by the way, in the US, the majority of the tax code is not for the average W-2 person. It is for the business owner to give them loopholes to pay less in taxes, to keep more money in their business, to keep more people employed. Okay. So taxes steal wealth. Inflation. I have a whole presentation about inflation. I'm not going to do it today, of course, but inflation is a wealth killer. And it is something, by the way, that is created by the federal government or the reserve and big banks. Okay. Volatility. Where do most of us put our money? Into the markets. Is it volatile? Yes. Can you lose your money? Absolutely. I've lost a lot of money in the markets. And so volatility kills wealth. Interest. Interest is one of the biggest ones. The average American family, I don't know what it is today, but a few years ago, or maybe before COVID, the average family was spending around $18,000 to like $20,000 a year just on interest. Imagine if you had that money coming back into your pockets. $20,000 of interest over 10 years, that's $100,000, that's $200,000 that you paid out in interest, the average family. Pretty crazy. Mindset. Mindset. So when we think about mindset, following the status quo, okay? When you follow that status quo, what we're taught to do essentially, man, it's hard to actually build wealth. Fear. Fear is one of the biggest factors that does not allow people to build wealth. It's just fear, right? Life, to be honest, life. As we go through life, we learn certain things. We actually learn these mindsets that may not be true, and that does not allow us to build wealth or be successful. And then it's just what we're taught. Because when we're young, we don't know good or bad, right or wrong, black or white. We don't know those differences, but we learn these things by those around us. And if we learn the wrong things about money, we're not going to be as successful as we should be. So mindset is a very, very powerful thing when it comes to infinite banking. By the way, I am a mindset coach. I have studied a lot of the mindset people out there. And so I'm a big one on the mindset. So I have trainings I do on mindset just because it is so powerful. And it's something I've had to do in my own life. Now, what's the definition of money? Okay, money is just a means of exchange, right? We give it value, so it has value. That's it, right? Okay, so that is the definition of money. It's just a means for exchange. Now, what company uses compound interest? Do banks use compound interest? No, they don't, by the way. They charge you interest, but they don't use it themselves. They actually invest your money to make compound interest, which is kind of funny, okay? Because here's the thing. If you wrote your money on a $20 bill and you put it back give it to the bank, do they put it in the back vault and leave it there? No, they don't, right? They don't put it in a box with your name on it. They put that money, that $20 goes into motion. So there's not a business that uses compound interest, right? Now, are your dollars worth more today or in the future? So think about this. How many candy bars could you buy with $1 20 years ago versus today, right? It's not as many, right? You could buy probably 2 to 4 back then. Now you can buy maybe half, depending on what kind of candy bar. It's crazy. Okay. So your dollars are worth more today, by the way, than they are down the road. That's the point right there. Will taxes go up or down? They're going to go up typically, right? Also, think of it this way. When you are retired, do you have more tax deductions or less? Typically, you have less deductions, so you're paying more taxes in retirement, which is kind of crazy. So what's better? What's better then? Is it better to pay taxes on the seed, meaning today, what you're planting today, or on the harvest down the road? Where do you want to pay taxes? On the seed, okay? That's where you want to pay taxes on. Okay. Now, here's something else to consider. Do you want to wait to eat bread or milk? Do you want to wait to eat those kinds of things? Okay. Typically not, right? Because they're going to be better today than they are down the road. So let's say if you take some bread or some milk and you put it into a freezer for 20 years, okay? Then you open up the freezer 20 years down the road and you've got 2 loaves of bread and 2 things of milk. Are they going to taste very good though? They've been there for 20 years. They're going to be freezer burned. They're going to be disgusting. So would you rather eat the bread and drink the milk today or down the road? By the way, I say both. I want to do both. That's what we're going to be talking about. Also, think of like a 401k. 401ks are one of those things that we're taught to go do. That is the best thing, right? Go do the 401k. You'll have more money down the road. But here's the thing with a 401k, IRA, things like that. You're giving up dollars today, strong dollars today, for weaker dollars in the future. Okay. You're also compounding the tax because the tax is always going to be there and potentially go up. So do you pay the taxes today on a smaller amount, strong dollars, or on a larger amount down the road? It's pretty crazy. Why do you think that the IRS likes you to do 401ks? By the way, what does 401k stand for? It's IRS section 401-K. Let me ask you a question. Do you think the IRS or Wall Street, by the way, has your best interest at heart? No, they don't want you to take your money out. They want to have more money in there because they're going to make more money down the road. It is, by the way, I won't say it's the biggest scam in the world, but it's pretty high up there, by the way. It's pretty crazy, but I'm not going to say that they don't work. I'm not saying you shouldn't have a 401k as well. I'm just saying you've got to be very aware of what you're doing with your money or what they're doing with your money in these vehicles, okay? Because they're using your money to make money for themselves, okay? So very, very powerful. All right. So what do you know about your retirement account? Well, I kind of just talked about that. Like Because when it comes to your retirement account, there's one major thing to think about. Who controls your money? It's your money. You worked hard for that money. Okay? Are you in control of it? No. Wall Street is. The 401k custodian is. If you want to take the money out, they're going to penalize you. But that's your money. It makes no sense. They're going to penalize you for taking out your own money. That is insane, by the way. It's crazy. So the other thing is, can you lose money in a retirement account? Depending on the kind, yes, you can. Okay. Now, I know that was a lot of information I just threw at you, but I want you to start seriously thinking about what you do with your money, because up until this point in our lives, we've just been taught to accept the traditional way of thinking about money. But to truly build generational wealth, you need to challenge those old concepts and understand how money really works. That makes sense? Okay. So let's talk about how your money flows. Okay. How does your money flow? So let's say you're going to go buy a car for $25,000. I know that might sound cheap, but it doesn't really matter if it's a Ford Focus, a Maserati, or a Ferrari. Same concept, okay? You're going to go buy a car for $25,000. Now, let's say that you have your money, that $25,000, in a local bank, okay? I'm going to play your bank. I'm Banker Brian here, okay? Let's assume you have that $25,000 in the bank and you're earning, let's just say 4% interest on that bank. Now, that's probably a pretty good bank if they're going to pay you 4%. They might be paying you that today, but maybe not tomorrow. But let's just say for this case, this example, $25,000 at 4%. Okay. Then you come to me and you say, hey, Banker Brian, I want to take the $25,000 out of the bank and go buy the car with cash. And I say, hey, wait a second here. Don't do that. Instead, here's what I'll do for you. I'm your banker. I will give you a loan, right, of $25,000 at 6% interest, and I'll use your bank account, the $25,000 earning 4%, as collateral for 5 years, a 5-year note. Okay, that makes sense? Okay. Now, here's the thing. Let me ask you a question. If your bank is paying you 4% on $25,000 and charging you 6% on a 60-month, note, are you going to earn more at 4% than paying 6%? Does that make sense? So here's the thing. So the answer to that is actually it's yes. So let me explain why that works this way. So your monthly payments on the note for the car, 6% at 60 months is $483, or basically $29,000 over that time period. Okay, you're going to pay back that note. It's going to be $29,000. But here's the thing. At the same time, you've been earning 4% in the bank. The future value of that money is $30,525. So you made more money earning 4% while paying 6%. Okay? So you made $1,526. So why is that? Why is that? Now, it's just math, right? It's just math, and math is math. Okay? The reason why is because the car balance is going down. The money balance in the account in your bank is going up. So you're paying 6% on a smaller balance every month, and yet inside your bank, you're earning 4% on a larger balance every month or every year, okay? So this exercise, what it does, and this is a mindset shift right here, right? Because we always say, oh no, I want to get a better interest rate. I want to pay less interest, right, at a smaller rate. But it depends on the loan structure and how you're making that money. So it proves that you can make money all day long paying 6% while earning 4%. Okay, it's just an example to kind of get your mindset shifting here a bit. Okay, so here's the money multiplier method we're going to be talking about here today. So one is the machine. What is the machine that allows infinite banking to function, to exist? Okay, how do we use that machine to keep our money flowing? Because money in motion makes money. Okay, and also by doing that, by keeping your money in motion and using the machine, you can keep that money coming back to you and staying within your family and in your control for the rest of your life. Okay, the next part is the marathon. Okay, we're going to talk about the fact that this method is a marathon. It's not a sprint. It's not a get rich quick. It's going to take some years to build this thing up, but once you do, man, it takes off and it's pretty powerful. Then last, we're going to be talking about everybody's favorite topic, the millionaire, right? How to be a millionaire using this concept. All right, let's go and dive on into it. So let's dive into the machine. All right, the machine is nothing more than a dividend paying permanent whole life insurance policy, specially designed, by the way, from a mutual insurance company. Okay. All right. Now you might be thinking, well, why in the world would I want to use life insurance like this? Because when I was younger, by the way, when I first learned about this like life insurance, I was like, wait a second, I'm healthy. I don't need life insurance. I'm very young, all that kind of stuff. But here's the thing. We're using this as the machine for infinite banking, okay? And the wealthy use these vehicles because of what they allow us to do. Remember that slide? I said, what will infinite banking do for you? This is the machine that allows the car, which is infinite banking, to go down the road. It's just the product, okay? So the elite do this. That's why we do this. Now, guess who uses this vehicle as well? Well, the number one purchasers of whole life insurance are banks. It's called BOLI. By the way, you can go Google this. It's called a bank-owned life insurance, or BOLI. Banks own, get this, they own more whole life insurance than they do their real estate and buildings combined. So if that's the case, why? Why do banks own so much of this right here? Do they know something that the average person doesn't? Possibly, right? Possibly. So guess how they buy these policies though? With your money. When you deposit money at the banks, they put that money to work in many ways. We'll talk about that here in just a moment. But one of those ways is through whole life insurance policies, cash value that gets them guaranteed growth of that money, but they're using your money to do it. So what we're talking about here is remove the bank and do the same thing the banks are doing with your money. That's one example of how this works, right? So it's pretty powerful. Now, here's the fun thing. When we talk about this and why banks do this, well, one, tax-free growth of your money. Okay. Infinite banking has been around. And by the way, whole life insurance has been around longer than the IRS, than the tax code, which is around 1913, by the way. This has been around longer than that. It's been around a lot longer than the 401k and other vehicles just like that. It has been around for a long, long time, hundreds of years. Okay. So maybe that's why the banks and the wealthy use it, right? Because it's been around and it's proven. Okay. All right. Now, how does your money flow? Let's talk about how your money flows. Remember, I mentioned, can you make money earning 4% while paying 6%? Well, the answer to that was an absolute yes, you can, right? We mapped that out. We showed how you can make more money at 4% than 6. Okay. So there it is right there. So let's look at how banks flow your money. Okay. Because this is one way to flow money, but how do banks do the same thing? How do they flow money? Okay. All right. So let's look at it this way. You deposit, let's just say $100,000 using round numbers, okay, into a bank, and let's say they do pay you 4%. That's awesome. What does a bank do though? Do they sit there on your money? Absolutely not, right? Money in motion makes money. So that's exactly what they do. So next up, they loan that money out on a home mortgage or a HELOC or something like that. Maybe at 7%, maybe at 3%, whatever. They're gonna loan that out. But here's the thing: does that money sit? No, it doesn't. When you buy the home, the seller who gets the proceeds from that sale takes the money or a portion of it and puts it right back into the bank again. Okay. What's that bank do? Puts it right back into motion again. They put it out maybe as a car loan at 8%. Well, guess what? Does the car dealership sit on that money? No, they don't, right? They pay their people. They pay maybe it's the manufacturer, but the money goes right back into the bank again. Okay. Well, the bank doesn't sit on it. They lend it back out maybe as a home remodel at 9%. Well, guess what? The contractors, do they sit on that? No, they've got to pay bills, but they do that through a bank. They deposit that money back into the bank again. What's the bank do? They put it right back into motion. They lend it back out maybe as debt consolidation loans, 12%. The credit card companies get that money, put it right back into a bank. So this is what banks are doing. Now, this is kind of nuts. So the banks make essentially 4 to 5 times off your money that you do. So they're making like 500%. You can see the math here. They're making money all over the place, all over the place. But why? How can they do this? Whoops. They can do this because they are in control of your money. They're in control of all of these transactions. But here's the thing. Where's the risk lie in these transactions? Think about this. Where's the risk lie? Well, they're not using their own money. And pretty much every single one of these loans has collateral, a car, right? A home, cash, right? There's collateral. So the banks essentially have almost no risk, okay? Now, granted, there's things that banks do that are called fractional reserve banking that gets them into trouble, but this right here is how banks make money. Banks make between 400 and 1,300% on the money that you leave there. By the way, go to bauerfinancial.com to look that up if you want. Okay. So let me ask you all a question right now. Okay. Give me one in the chat box if you want to do the same thing the banks are, but with your own money and be in control of your own money at the same time. Does that make sense? This is what banks are doing. So who wants to do the same thing the banks are, but you remain in control? Don't give away control, right? Yeah, yes, there you go, Carol. Yeah, yeah, Sham and James. Yeah, we want to be in control of our money because when we give our money to the banks, they're in control of our money. Now, before I learned this kind of stuff, I thought banks were oh, this is great. I have my money there. It's safe, secure. Well, guess what? In the Great Depression, how many banks went under? 9,000, by the way, 9,000 banks went under. That does not seem like the safest place, right? How many mutual insurance companies, infinite banking, by the way, went under during the same time frame? Zero and under during that same time frame. So it's pretty powerful to know that. And so now when I go to the banks for, to do a transaction to, cash out a check or something, I look and I see a little cup or bowl next to the teller. And it's kind of funny. Here about a couple months ago, I took a picture while I was in the bank and sent it to our Money Multiplier team members because it was dum-dums. And I was like, yeah, there it is right there. And it was pretty funny to see that right there. I'm like, man, my mindset has shifted, right? And so it's kind of funny to see that, right? So that's how banks function. That's what banks are doing. That's why they love to have your money in there and they don't want you to take it out. And by the way, if you go to try to take out a bunch of cash, like I'm talking $50,000 in cash, do they let you do that? Well, they kind of have to, but guess what? They're going to record it. They're going to report it. That's insane to me. Like you're going to get red flagged if you ever do that. Okay. But with infinite banking, it doesn't work that way. Okay. So a little bit different. All right. Now let's kind of look at the annual pattern of spending. Now this one, when I first learned this, it blew me away, to be honest. I was not aware of this. So this is how most people spend the money that you make. And this is pretty powerful. So pay attention here for a second. All right. So 20 cents of every dollar on automobiles. So out of every dollar that you make, around 20% is spent on automobiles, payments, gas, upkeep, things like that, right? Okay. 30 cents of every dollar, 30% goes to housing, mortgage, right? Rent. 40% of every dollar goes to everything else, travel, entertainment, food, clothing, things like that, okay? Excuse me. Okay. So 90 cents right there goes to other people. Other people are making money off of your money. That's what's happening. 90 cents, by the way. And 10 cents, just 10 cents or 10% go to savings, okay? Now, this was about, I don't know, a few years ago. And the average saving rate was about 5 or 6%, by the way, back then. So it was even less. So it's even less, a few years ago. So that's kind of crazy. And I think before the last recession, before COVID hit, it was a negative number, which is nuts to me. It's a nuts. And so what's interesting is that when you talk to like financial planners or financial advisors, what number do they talk about? Okay, what number do they talk about? Is it the 90 cents? No, it's not. Most financial advisors, they talk to you about the money you're saving, right? The 10% right there, right? That's what they talk about. And they say, hey, to get a better return on the money, because hey, you've got to catch up for retirement, right? Oh, you got to get, a higher return. What does that usually mean? More risk. More risk. Now, I got to be honest, in the current, markets and economy and world, I don't want more risk. I want less risk. Who here wants less risk? Give me one in the chat box. You guys want less risk. Okay. I know I want less risk. For my family, I want less risk. I don't want more. Okay. I want less in my life. Okay. So here's the thing. Yeah, there you go. Yeah, less risk, more money for us. Exactly. Yep. Less. So I'm not going to talk to you about the money you're saving. Now, yes, we want to save money and put that aside. Well, one of the best ways is, by the way, through infinite banking. Okay. But what I want to talk about more is what you're spending. Okay. Because I want to take some of the money that you're spending and move it into your savings category without changing your cash flow. Okay. without losing control of your money and without taking on any more risk. So someone said, Curtis said, yeah, I was red flagged when I withdrew $10,000. Absolutely. Exactly. Yep. That's what happens. And I've had it happen too on some very large numbers. And it was kind of scary because they didn't want to do it. It took days to get the money out. So yeah, I didn't like that. So I want control. All right, so let's talk about how we're going to move some of the money you're spending into savings. Okay, so let's look at what would happen if you moved all the interest that you're paying into your savings. Now, as I said, on average, people spend 20 cents of every dollar they earn on their car, right? So 20 cents of every dollar earns on their car. Now, here's the thing. Of that 20 cents or 20%, 5 cents or 5% of that 20 is interest. So what I'm going to do is remove the 5% and put it into your savings. Okay. So it reduces that and increases your savings. Okay. Here's the crazy thing. Now, let's say on average, 30 cents of every dollar goes to housing. Okay. That's 20. And by the way, how much of that 30 cents goes to interest? 25% on average of the 30 cents for housing goes to interest. That is a lot, by the way. It's a lot. And so why is it that way? Well, when you have a 30-year mortgage and you're saying, I'm going to refinance from a 6% down to a 2%. By the way, that is usually not a very good thing to do when you look at the total amount you're going to pay for that house. But here's the thing. For the first 7 to 8 years, around 80% of your payments go to interest. 80% of all that, the first 7 years goes to interest. So we're going to move 25 cents of the 30 into your savings. Now, if you're renting, by the way, it's 100% goes out the door, doesn't come back to you. All right, now we also said that 40 cents of every dollar is spent on living expenses, of which around 5% of that 40 cents, so 5 cents goes interest. So let's go ahead and move the 5% into savings. Okay, so what have we done? So we have essentially shown that if you become the bank, if you can control your money, if you can pay yourself back, guess what's going to happen? Your savings, or the money that you have available for the rest of your life, is going to change, is going to flip-flop. You're going to have a bunch more money available for you, for your family, for the next generation, but also for you to live on today while living, okay? By just changing the cash flow, by using infinite banking, flowing money there first, okay? So once again, we're talking mindset here because we're not taught to do this. We're taught to leverage ourselves, right? Borrow money from the banks to live our lives, but that takes money away from us and gives it to the banks. So we're going to flip that around. So let's go ahead and show some examples of what this can look like in real life. Okay. So what we're going to show you now is how to get all the money back for every car that you ever buy, drive, and own. Now that's a very cool car. That's a Mustang. I've had Mustangs. I have a Mercury Cougar. So this is a very pertinent example right here. So let's go and dive into this one. So let's look under the hood. Okay. So now this is a example of what an infinite banking kind of structured policy can look like. Now, don't get into the numbers. I'm going to show it here, but bottom line is this. When we look at the machine is the dividend paying permanent whole life insurance policy with a mutual insurance company. Okay. It's a mouthful. Okay. Now, when people hear the word insurance, they think of premiums, they think of expenses. So think of like a home insurance, car insurance, health insurance, right? Those are bills. When you pay that money out to like a car or a home or something like that for car insurance, you're not getting anything back, right? This is different. We call them deposits, premium deposits, because when you deposit these into the policies, you have liquid reserves of cash value that you can take out of the policy as loans, okay? So by the way, these are specially designed policies. The average person cannot build these or go get these. You have to know how to do these, okay? Just keep that in mind. These are specially designed for this. The average person that does insurance cannot do these, or they don't know how, by the way. So keep that in mind, okay? So once again, I want to change your mindset around some things. When you hear premiums into infinite banking, think of deposits, depositing money into your bank so you can then borrow that money out and go do the things we're going to be talking about, okay? Also, age, because people hear life insurance and they think, oh, age. Does age matter? Not really, because you can use these on other people. I have clients that are 18 years old and clients that are 70 in their early 70s. Okay. Now, technically, the older you are, the less death benefit or generational wealth you're going to have because of the time horizon you have left. Okay, kind of a weird thing, but I am going to mention that, and I'll get into that a bit more. But here's the fun thing about infinite banking is that you can do this on other people. It doesn't have to be you. It can be partners, can be spouses, adult kids, grandkids, all those kinds of things. Now, there are some structures that we have to look at, but you can use this, and we actually do that all day long. Okay, and then last, death benefit. Now, we don't talk about the death benefit because in infinite banking, we are trying to shrink the death benefit so we can focus on the living benefits of infinite banking. I'm going to repeat that because it's very, very important. We decrease the death benefits in the beginning, by the way, the beginning, to focus on the living benefits and maximize the living benefits of this concept and this strategy. Now, the death benefit is very powerful though because it is guaranteed generational tax-free wealth. Day one. Okay. And I'll share a bit more about that in a little while, but it is powerful. But once again, it's not the focus of this. Okay. If you go to a traditional agent, by the way, that is what they're going to focus on. Okay. Not us. All right, let's go and talk through the machine. So I'm going to look at an example of buying a car and how you can reclaim the interest on this. It's pretty cool when you see this. So let's say you have a policy and you're going to put in $10,000 per year deposits into your policy. And let's say you're going to do this for 7 years. At year 3, you're going to buy a car for $25,000. So you're going to take $25,000 of cash value out of your policy. So you're going to actually use that as collateral for a loan. Okay. You're going to borrow against the cash value. And then you're going to pay back your own loan. Remember, this is your bank, right? You're going to pay it back with interest over the next 5 years at $6,000 per year, paid monthly, $500 per month. Okay. Doing the math right there. What's that mean? That means that after 7 years, you've put in $70,000 of deposits and $30,000 of car loan payments back to your own bank. That's $100,000. But you also had $25,000 of cash at the same time. So in reality, how much have you put in? To $75,000. That makes sense? Because that cash you paid cash for that car. Okay. Now the car is just an example of what you can do with that cash, but you had the cash and you go buy the car with that. Okay. So $75,000 net. Now here's the thing. You have, because you have that 75K net, you have recaptured 91 cents of every dollar you've invested because you have $67,000 of cash value in your account. You've recaptured 91% of that money. Like that's powerful, but it gets even better. Okay. So just keep in mind that 91 cents right there is that's amazing. Okay. Now, here's the thing. At year 8, look at this. At year 8, we put no more money into the policy. Now, by the way, that is a choice. You can keep funding this if you want, keep putting deposits, which we do recommend. But let's say in this example, you put in no more deposits after year 7. So year 8 through 12, no more deposits. Yet here's the thing. At year 8, you go buy another car for $25,000. Okay. So same thing. $25,000 comes out against the cash value. You pay that loan back, that car loan back. Once again, $6,000 per year for 5 years. So what's the math? Okay. Well, at this point, you put in additional $30,000 into the policy. Okay. Through the car payment loan back to your policy. Okay. Now, here's the fun thing. You took out $25,000. So how much did you really put into the policy? Well, it's only $5,000. But guess what? During those 5 years, your policy went up in value, cash value, by $23,592, but you only put in $5,000. So think about that for a second. You put in $5,000, but you now have $23,592 more that you can leverage out of your policy. That is pretty powerful. Is that a good cash on cash return? That's about what? 4xing the money right there, a little more than that, 4.5. Yeah. And Don, I'll get into that in a little bit too. But yeah, that's what's powerful about this. And by the way, the longer this is in place, the better and better and better it gets. And this is just a simple example, just trying to keep it kind of high level here. Okay. And I'll show you some examples, some more detailed ones in a little bit, but I want to start off kind of keeping it high level here. Okay. So 3 rules that make this machine work for you. Now, one is pay yourself first. We've been trained, by the way, to pay all of our bills first, then take whatever's left over and put that into savings. But that is, by the way, the wrong way of thinking about money. Paying yourself first means that you put money into savings first, then you pay your bills or you pay other things, right? Because you want to make sure that you have that money working for you. Pay yourself with interest. If you have to pay a traditional bank back with interest when you take out a loan, you should be an honest banker with yourself and also pay back interest to your own bank. Make sense? Okay? Because you cannot recapture interest if you don't deposit that into your bank. And last is to recycle and recapture your money. So, would you agree it's better to pay yourself interest than the traditional bank? Because you're going to get a lot more interest out of that interest, by the way, right? Than the bank is. Okay. Okay. So those are kind of the 3 rules right there. Now, the car is a simple example. So if it works for a car, what else does it work for? Okay. So one of the other things that a lot of people of our clients want to do is recapture debt, because debt, by the way, is one of the worst things when it comes to losing wealth, right? It just takes wealth away. So recapture your debts. So let's go through an example here. Now, this is a 45-year-old doctor, male, and he has 9 third-party debts. You can see right there. This is a real example, by the way. And $478,000 in debt, total debts. Okay. So we're going to do a policy, by the way, of $25,000 per year. But right now, this individual is paying $5,770, or yes, $507 per month towards all these debts. That's like $69,000 a year. Like, that is a lot of money. It's going to take him 19 years to pay this off. So 19 years to pay it off. Okay. So we're going to do a policy that is $25,000 yearly policy deposits. Okay. All right. So when he puts $25,000 into his policy, his infinite banking policy, he's going to have, within the first 30 days, by the way, around $14,863 of cash value. Now, by the way, being very conservative is typically a lot higher than that, but we're being very conservative with you on this presentation, but it's definitely quite a bit higher than that. But I want to be a conservative. So $14,000 of cash value. Okay. So now what do? Well, we borrow against that cash value, take that out, and we pay off the Discover card, pay off Lowe's, pay off portion of the Nordstrom card. So what happens now when you do that? Okay. Here's what happens. The monthly payment goes down by $448. Now, that's cash flow that is no longer going to the debts. So what do we do with that $448? Well, we want to be an honest banker. So what do? Well, we put it back into our policy or back into a separate account to hold on to that money, okay? Because we want to keep that money in our control. We want to put it somewhere, not just spend it, okay? So it goes back in. So now what happens in year 2, okay? In year 2, an additional $25,000 goes into the policy. The cash value now goes up by $16,571. And you might be thinking, well, Brian, why did it go up by 16 when it went up by 14 year 1? Well, compound interest, okay? Because you're earning money on the money you put into the policy. It goes back in your cash value, so it goes up higher. Now, the $448 that goes back in created an additional $5,374 of available cash value to borrow against. So the total cash value that you have is $21,945. So what do? We borrow that out, pay off the Nordstrom card, Wells Fargo, and the private loan, and a portion of the BMW, okay? Now what happens? The monthly payment goes down. So now we reduce the monthly payment by $1,917, okay? Now you're still going to be making the $3,860 to the loans, the debts, but you now recaptured a large portion of that. And once again, you put that back into your own policy or back into your own account to hold on to that. So year 3, deposit $25,000. Now the cash value goes up by $25,541. Pretty powerful, right? The payments back to your bank, that was $23,000 and change. So the total cash available is $48,545. Repeat the process. We pay off the BMW, pay off West Marine, and a portion of the condo. Now what happened? Our monthly payments went down total by $3,677. You guys starting to see the picture here? It's pretty powerful, right? So you've reduced your debt down to $283,000 as well. That is pretty cool in 3 years. 3 years, okay? Now, once again, the marathon, okay? So I want to stop here for a second before we get to year, I think year 4. So how much did we put in? Well, years 1 through 3, 25,000 each year is $75,000. Well, we borrowed against that for the first 3 years of $55,000. So how much do we have in the policy? Earning the dividends, earning the compound interest. Well, a lot of people would say, well, guess what? If I 75 less 55, I only have $20,000 in the policy. That's wrong, right? Because remember, we are leveraging the cash value. It's the collateral from the general fund of the insurance company. So the actual amount that we have is $75,000. So you've borrowed 55, yet you're still earning growth and compound interest on the full amount in the policy, $75,000. That's going to be earning you right now around 5%. No matter what you borrow, it's still going to earn 5%. That is extremely powerful right there. Okay. All right. Let's look at year 4. Okay. Deposit another 25,000. Cash value goes up by $26,304. Payments back to your own policy loan are $44,124. Total cash available is $70,439. So now we pay off a large chunk of the condo. Now, because the condo and the house are amortized loans, the monthly payment does not change after this one. Okay. So in year 5, same thing. 25 goes in, 27K of cash value. Payments back to ourselves is the same, 44,000 and change. Total cash value available is 71,000. You borrow that out, pay off the condo, a portion of the house. Now your monthly payments went down to only $1,221, and you're taking $4,556 and putting it back into your policy loans and back into your own bank by being the responsible banker. And your debts are only the house right now of $91,000 and change. Okay. So in year 6, we do something a bit different. In year 6, we say, hey, you know what? I'm liking this. I've got a raise. I got some more cash flow. I'm going to do a second policy, and I'm going to reduce the amount I'm going to put into my first bank. I'm going to open up a second bank. Okay. So $10,000 goes into the first bank. Okay. Instead of 25, and the cash value goes up by $13,000 and change. The next bank, your second bank that you open up, you put in $25,000. Maybe it's on your spouse, maybe it's on somebody else. Okay. Cash value of $14,863 in that one. Okay. The payments back to your policy loans is $54,678. So how much cash do you have available now to borrow? $82,000. Well, guess what? You wipe out that house loan, your payments go to 0, and you are debt free. You take that cash flow of $5,777 in year 7, pay back your policy loan. At the end of that, guess what? You're going to have a large amount of cash value, probably over $100,000 in your policy. Actually, more than that, by the way, and no debt, and $5,777 of cash flow coming in that was otherwise going out to debt. Would you rather pay off the debt in 19 years or 7 years? So if it's 7 years, give me one in the chat box, guys, if you would rather pay it off in 7 years versus 19 years. Pretty crazy. Okay. Pretty powerful. Okay. Yeah. Yeah. Eric says 7. Yep. Exactly. Right there. Exactly. So 7 years. Now, here's the thing. You might be saying, well, Brian, that sounds pretty cool, but how the heck do you do that? That there's a lot of numbers and stuff moving around. Well, here's the thing. So we have a trademarked tool called the Debt Blaster that does this for you. So that person right there did that based upon our mapping of that for them. Like they didn't just guess on how to do that, by the way. We showed them exactly how to do it. So we have a software called the Debt Blaster that all of our clients can use. We do that for you, and we'll map this out for you and show you exactly what it will do. But we also, it's kind of cool. We compare it to, like, if you paid the debt just normally, like every month is paid it traditionally, versus if you did it with blasting it away with the velocity banking or snowball method. We compare different methods, but infinite banking almost always wins. Okay. And so it will show you exactly how much interest you'll save, how much total payment you'll save, how much cash value you'll have. And as well, you have the death benefit the entire time. So yeah, when you look at infinite banking and paying down debts, it's very, very number driven and mathematical driven. So it just makes sense. So when you see it, yeah, it's amazing. So So here's the thing. So we have a team that does this. So this is called our iMapping team or implementation team. And so we're gonna create your own personal blueprint for Be Your Own Bank on what I just showed you. Okay. Not only that, we do it for some other things too as well. So I'll get into some of that, but that's one example of how it can work. Now, next, I want to kind of talk about the Millionaire, because this is a question I get quite a bit. And someone says, well, Brian, what if I don't have any debts? What if I don't need a new car? Can I still benefit from privatized banking or infinite banking? The answer is absolutely yes, 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 yes. Because here's the fun thing. When you pay off the debts and that money is no longer going out to the creditors, you flip-flop and now start building wealth faster. Because if you're paying debts and trying to build wealth, it's very challenging sometimes. But what if you pay off the debts, recapture that money, and now you have the cash value and the cash flow? Do you think you can build wealth faster? Absolutely. Absolutely, yes, you can. So that's where the fun begins, because now you flip-flop and start building real wealth. So that's what a lot of people do, of course. Now, also, what are the other ways that you can use infinite banking? Well, active real estate investors, wholesalers, flippers, buy and holds, commercial property. These are other ways you can use infinite banking, by the way, for building wealth, mobile homes, that kind of stuff, having private funds, passive real estate. So lending your private funds, by the way, on real estate. Business owners, by the way, a lot of business owners look at infinite banking and realize, man, if I can make this part of my business, I can do a lot of fun things, and you can. Stocks, options traders use this. Startups, by the way, a lot of startups will use this, and then even equipment flipping, like flipping equipment. So remember saying, what do you mean by equipment flipping? Well, Chris and our team here, we actually do equipment flipping. So a lot of us do equipment flipping, and we show some of our members how to do that if they want to be part of that group. But yeah, there's lots of ways to make your money work. So money in motion makes money. So I want to give you a quick example of using private banking for private money lending. Okay. So this is what it kind of looks like. Now, this is just a general example here. Don't get tied to the numbers. I'm just using some round numbers for simple math. So in this example, someone's putting $50,000 a year towards a policy, and they're putting $100,000 in upfront. That's called a dump in. I'm going to talk about that here in just a moment. So in this example, within the first year, they have $132,000 of cash value, but the longer infinite banking is in place, the better and better and better it gets. So as an example, let's look at year 8. So in year 8, this person has a growth or increase of cash value of $66,000. That's how much their cash value went up by, that they can borrow against. Okay. But here's the fun thing. So it grew by 66,000, but they only put in $48,593. So is that a pretty good cash on cash return? It's a 37% cash on cash return, right? Because they had $18,000 of growth on that $48,000 deposit into their bank. So who would like to be able to put in $48,000 or $8,000, doesn't really matter, and get a 37% growth of that money? And by the way, that never goes down. It keeps getting better and better year after year after year. Like, that's pretty amazing. I mean, give me one in the chat box if that's something you guys would like to have in place. I mean, does that math make sense, right? Do you guys want that, right? That's a very good growth of your money right there. 37%, but it gets even better, okay? It gets even better. So let's talk about this for a second. So let's say you're going to private lend the money. So like a hard money lender on real estate, okay? So typically that's around a 12 to 15% rate when you lend out your money on real estate as a private money lender, okay? So let's say you do that. Let's say you borrow, the $66,000, you private lend it out at 12%, you pay your own bank back at 5%. How much did you make? It's 44%. So let me ask you another question. Just think about this. Now, we did nothing different except where our money went first. You could have lent out the $48,000 and made 12%, but by having infinite banking in place, you're making 44%. So would you rather make 12% or 44% on your money? Like, do you understand why the wealthy do infinite banking now, right? Be your own banker. That's why they do this, because they're making these kinds of returns on their money. Their money is working for them, okay? That is why this is so powerful.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So So get in on the action like so many others have by going to privatemoneyclub.com and sign up.
Now, I'm not going to go through all the numbers on this. I just want to kind of paint a quick picture here. This is the power of uninterrupted compound interest. So on this one, on the left-hand side, you'll see year and age. Year 2, year 5, year 10, year 15, year 20, 30, etc. Okay? So that's just showing you the year by year. You have a deposit into your bank of $5,895, and you have return because of the compound interest. So what are those returns? Well, on the right-hand side, you'll see cash on cash and access to capital. Okay? So cash on cash, and by the way, this person put in $50,000 dump in, and they're paying around $6,000 per year in premiums. Okay, so that's what they put into the policy to fund it up front. That $50,000 is called a dump in. That gets cash value very high, very quickly. Year 2, they're cash on cash positive 21%. Year 10, 54%. Year 20, 191%. Year 30, 386% cash on cash return. So those numbers sound like almost too good to be true. But keep in mind, it's compound interest and it's over time. It's not year 1, by the way. This is year 10, year 20, year 30. Okay, so it does take time. But your access to capital in year 2 is 121%. Not 50, not 90, it's 121% access to capital from what you put into the policy. That's insane. Year 10, it's 154%. Year 20, it's 291%. Year 30, it's 486% access to capital ratio. That's awesome. That's amazing. This is how you build wealth. Like, this is how you can build wealth. Okay. All right. The last one I want to talk about is the millionaire. So how do you eat an elephant? Okay. We all know the answer to the question. You probably heard it many, many, many times, but it's one bite at a time. So what do I mean by that? The man at the top of the mountain did not fall there. He climbed up there. But here's the thing. How do you get there? You've got to take that first step. Just being honest, you got to take that first step. And what happens a lot of time is people don't take that first step. They see the man at the top of the mountain. They see that where they want to be. They see the wealthy person, the investor. Oh my gosh, look at that person. I want to be there. But they don't do the one thing that other person did. Take that first step. You've got to do that. You've got to take the step. And then you got the next one and the next one, because what'll happen? Eventually, you'll be at the top of the mountain. That's how it works. That was one of my biggest lessons, by the way, is that I kept doing the same thing over and over and over and getting the same results, wanting different results. I had to do something different. I had to take the step in the other direction. So I kind of like that one. And another question I like this one is, is it possible to owe no man nothing? I think yes. Maybe not always, but yes. So here's the thing. So I just showed you a few examples: private lending, debt, and buying a car. The machine, it works for debt and expenses, vacations, homes, taxes, everything. Okay. So this is how we truly start to build real wealth. So let me go back to one example. So we talked about the home and the condo and paying down the debts, right? So if we continue to pay the homes back as promised, here's what would happen. The condo monthly payment was $879 per month. 251 months is $220,000 total paid back. Okay. The house was $1,221 at 224 months. That's $273,439. How much is that combined? By the way, that's over many, 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 many months. It's $493,000. Okay. That's how much you would pay back to the bank. Now, by using the money multiplier method, infinite banking, you're going to have that money back in your pockets and not the bank's. But here's the thing, it gets even better because you're going to be earning interest. I'm using 4%. I'm being conservative, by the way. It's actually 5%. Been that way for, gosh, I don't know how many, by quite a long time, by the way. But let's use 4% just to be conservative. Okay. You're going to be making money off these kind of things. So in reality, you're going to have $750,000 in your policy over the same time period. Plus you have the condo and the house paid off. Okay. So would you rather pay, what was it, $493,000 and have zero left, or have $750,000 plus all the benefits of infinite banking? So kind of start to see why this is pretty amazing. Like, that is what you can do. Okay. Now, some other things that you can do to be, to build that wealth and become that millionaire. So this is called the gains projector. So these are other resources that we have that you have access to. So the gain projector will show you how an investment, like let's say real estate, will work with infinite banking. We're going to show you the projected net benefits, the growth of the policy, the growth we're going to make off the investment. We're going to show you all these things if you want. So if you have like deals you're doing or real estate things or investment opportunities, and you want to like say, hey, how will this work with infinite banking? We will map it out for you. Okay. You do not want to be guessing on these kinds of things, right? We're going to show you how to do this. And so I'm not going to go through the numbers on this, right? But I'm just going to show you that we do have these things for you. We produce these results, and then our implementation team will work with you to put this in place. Okay. So now that you know this, everyone should do this. Now, here's the thing. Can everybody do this? The answer is no. You do have to qualify, and we can talk about that. But yes, you do have to qualify for this. But guess what? If you don't qualify, maybe somebody else does. But here's the thing. If you don't learn how to do this and pass this kind of stuff on, I truly believe that you're basically stealing from your next generation and that next generation as well. So guys, by the way, the only thing to do right now, if you guys want to talk about how this can work for you, you can go to brian.beyourownbanker.com and you're going to hop on a call with me personally. Okay. And I'll walk you through any questions you have, the numbers. If you have any questions about the numbers, about how it can work for you, we're going to look at what we're going to be solving, the solution, and how infinite banking can change your financial life. So that is what I do, by the way. This is what I do full time. So once again, if you want to talk with me personally, go to brian.beyourownbanker.com. Now, I'm not done, by the way. Okay, I'm not done. We're going to go do some questions and things like that. But that's the link right there. So now keep in mind, like who else is doing this? We talked about it. The Rockefellers, the Rothschilds, the Morgans, the Stanleys, the Barclays. They all understood how to keep money in their families, how to keep that wealth with the family. Okay, that's why they do this, because I truly believe this. We have to break the bonds of financial slavery, because some of us don't even know that we're in financial slavery. I didn't know it for decades. Okay. I didn't know that. And so when you break free from that, infinite banking is one of the best ways I have seen to do that. Then you are in control. Okay. And being in control of your mind is amazing. In control of your money, awesome. In control of your time as well, that's life-changing. It is life-changing, by the way. Okay. And by the way, it doesn't matter if you're making $10 per hour or $10,000 per hour, this can work for you. Okay. Because here's what infinite banking is truly doing for you. It's making your money work for you by being your own banker. Because do you want to be the guy at the bottom, right? Trading time for money for your entire life, or the guy at the top where your money's working for you? So give me a 1 if you want to be the guy on top. If you want your money working for you and you not working so hard for your money, give me 1 in that chat box. You guys still there? Hope I didn't put you to sleep, by the way. But yeah, and so I'm going to go through a few more things about what infinite banking does, by the way, because there are some other things that I didn't even get into yet. We just went through some of the examples of how we can use this, but there's so many other benefits. Because here's the thing. You might say, well, Brian, like this one thing doesn't make sense to me. Like I don't want to do it because of that. Well, guess what? When you stack the benefits, it all of a sudden people are like saying, oh, now I kind of get it. This is why it's so why people do it, because of all these stacked benefits. That picture should be the other way around. Yeah. All right. So let's go look at some other things. So let's talk about some other benefits of infinite banking. Okay. The death benefit, I did mention it. Okay. That death benefit is guaranteed. So think of that for a second. When you have one of these things in place, day one, that exists. Now, of course, we don't want to have, things happen to us, but life is life, right? What if something happens next month? Is it good to know that your beneficiaries, your family, your loved ones, or whomever is going to be basically taken care of, guaranteed, tax-free, by the way? Yeah, so it's passed on tax-free, okay? When you borrow against your cash value, okay? When you borrow against it, the loans are in your control, by the way. They don't have to be repaid. I'm going to talk about that in a moment, okay? The internal values grow tax-free, okay? They grow tax-free. That's pretty cool. The policies are exempt, so the cash value, that asset, is protected and exempt in most states from judgments and liens and court orders and creditors, okay? So why do you think wealthy people want to do this? Because they want to protect their money, protect their wealth, okay? Tax-free income in retirement. tax-free income in retirement. Does that sound good? Yeah, that's pretty powerful. Okay. And Yvonne, I can give you my my personal information if you want here in a moment too. So that's also very powerful. Let's talk about the generational wealth aspect of infinite banking, because this is something that a lot of people, like, they don't realize that it does. But here's the thing. It's an always increasing generational wealth strategy. So see on the right-hand side over there, year one, this is a 43-year-old individual. They put in $20,000 per year. Okay. The death benefit is $325,000. But what is it on year three? It's over 400. At year seven, it's almost $500,000. It's an always increasing generational wealth strategy. See the cash value next to the death benefit? 17,000, 36, 56, 77, 99, 113. It's always going up. Very, very incredible. Okay. So generational wealth always going up. Policy loans. You're borrowing from your bank. What's that mean? Okay. Well, your policy loans are guaranteed. You don't have to ask permission. You're guaranteed these loans, by the way. Okay. There's no credit check. There's no approval. Ask and you shall receive the money. About 2 to 3 days, typically, by the way. Okay. The loans are private. So think of it this way. They do not go on your credit report. Okay. They're not on your credit report. When you borrow from these, it's a private note. You are in control. But think of it this way. Let's say you want to recapture debt or pay down debt. When you pay those debts off and move it into your own policy, your own control, what happens to your credit report? The debts go off of it. The debts are in your policy now, you're in control, but they're not on your credit report. That's something that a lot of people don't realize, because now you have more power for, maybe it's lending, maybe it's borrowing, maybe it's a HELOC, maybe it's a mortgage, things like that. Okay. No minimum or maximum payments to your policy loan. You are in control. Do you want to make $100, $50, or $1,000? It's up to you. Hey, do I have to make a payment this month? The answer is no, you don't. You are the one in control. Okay. Very, very interesting, because a lot of people don't realize that that's how these things work, right? Miss a payment, nothing happens. If you miss a car payment, what happens? Well, they're going to come after you, right? They're going to take your car. Okay. With this, nothing happens, right? So how can I fund my bank? So this is a very common question, is how do I fund this? How can I put deposits into my bank? Okay. Well, you can do them monthly. You can do them quarterly. You can do them annually. It's up to you. Okay. And you can change that, by the way. Okay. 10 times your age per month is sort of the minimum starting point. If you're 50 years old, 500 per month. If you're 20, 200. Make sense? That's the minimum. The maximum you can put towards these, it depends on the individual. It depends on gross income. It depends on liquid net worth, net worth, those kinds of things. So that's going to be per individual, by the way. So I can go through that with you and run through the numbers on that. Now, here's the fun thing. On top of the premium deposit, you can fund the policy with a large upfront dump in. Now, why would you want to do that? Well, because when you do the dump ins, like let's say it's $10,000 per month or per year and a $50,000 dump in, of the 50, around 90% goes to cash value within the first 30 days. Okay. So what we do when we build these, which is very unique, we maximize the amount of cash value you have within the first 30 days. Now, eventually, as I showed you, you're going to have significantly more cash value than you put into the policy. Okay. But here's the thing. Let me ask you a question. Would you put in $1 in order to get $3 out of your policy? Like, that's a massive yes for most people. Okay. That's a massive yes. Of course, I'm going to put in $1 if I can get $3 out. So what do I mean by that? All right. So let me show you this example right here. So in this policy, this person is putting in $10,000 per year and a $50,000 dump in. Now, here's the numbers. Year one, they put in 60. At the end of the year, they have $55,000 of cash value they can borrow against. Like, that's amazing. That's awesome. Here's the thing. Year two, now they put in 10,000. They get $10,607 of cash value growth. They're cash on cash positive. They're putting in 10, getting $10,607 out of the policy. Okay. In year 11, as an example, they put in 3,120 and they have $10,590 of growth in the policy. If you can pull 10,000 out, would you want to put in the $3,000? Most people would say yes to that one right there, because that is a very good cash on cash return, and you can pull that money out. So you're going to have more and more money that can go work for you in other vehicles. So when you think about this, you put in 3,000, you have 10,000 of growth. That's growing wealth right there. But then you take the 10,000, or by the way, it's the $185,000 next to it, and you leverage that into other investments or other opportunities and further build your wealth. That is really where you're putting your money into two places at the exact same time. That's really where you start to really see the wealth take off. Okay. Now, Warren Buffett's quote, if poor people would just do what the rich people do, they wouldn't be poor anymore. Like, it's an interesting quote to think about that, because now that you know this, do you want to do it? Right? Now, why should I work with you, Brian, or with a money multiplier? Okay. So I personally have been teaching IBC, or infinite banking, for a little over 7 years now. And combined with our team here, it's probably centuries of experience with infinite banking. Okay. We have an entire team here. We have over 40 team members that works with you to set up infinite banking. And all we do, by the way, is infinite banking. That's all we do. And by the way, once again, to schedule a call with me, just go to brian.beyourownbanker.com or click the link in the chat box that Steven just put there. Our team is one of the largest producers of infinite banking in the US. Like, we're not small. We're not doing one policy a day. Okay. We have a lot of repeat clients, by the way, a lot of repeat clients and a lot of referrals because of our team and how we handle infinite banking with our clients. Okay. I personally have, I think it's over 100 clients right now in underwriting for infinite banking. We have ongoing support and services. So we have ongoing support while doing the policy and after the fact. So you have all these ongoing support for you as well. And then there's no cost. So this is a question we get a lot. No, we do not charge you anything. There's no cost that you're going to pay to us. Okay. So that's something that's very important that I say, because a lot of people are asking, oh, how much is it going to cost me to do this? It's not. There's no cost. We don't charge you anything. If someone's going to charge you, run the other direction, by the way. Okay. One other question I want to note here is IUL, or Index Universal Life, or Variable Universal Life Infinite Banking. I'm going to just nip this one in the bud really quick. No, it's not. IULs and term insurance pay some of the highest commissions, whereas infinite banking pays the least. We take about a 70% pay cut to do infinite banking for you. And our team only does infinite banking. That's all we do. If you want to talk about IULs, schedule a call with me, but IULs are not infinite banking for a lot of reasons. If you go to the Nelson Nash Institute, which certifies IABC, or infinite banking practitioners, if you do IULs, they will not allow you to be certified, period. They will not even touch you. Okay. So keep that in mind. Now, only one of two things will happen to us in life. Only one or two things will happen. We live. Okay. Do you think we're better off with or without infinite banking in our lives if we're alive? Okay. So I would say with. The second thing we know that'll happen is we do die. Okay. And because of the things I just talked about, the generational wealth, those kinds of things, are we better off with or without infinite banking in our lives? Okay, it's with. Okay, it's with, right? Now, I'm almost done, by the way, guys. And if you have any questions, go ahead and start putting those in the chat box, and I'll get in touch with you guys or answer the questions live. Okay. This is kind of a funny story here. That there's an analogy I like to do. It's called the tale of two peoples. You may have seen this in other presentations, but when it comes to things like this, I see a tale of two peoples, because here's the thing: wealth is always being transferred. It's always happening, and right now it's happening faster and faster. And so I see two different groups of people. Well, there's group one. Group one is the people that just say, I'm going to keep just doing the same thing over and over. I'm going to keep working harder. I'm not going to do anything different. And they often are stuck. They feel stuck. They're doing the traditional things. They're putting their money into a 401k or with a financial planner. They're trading time for money. They're trying to pay down debt traditionally. They're stuck. Okay. And that group is the one where wealth is stripped from. It's taken away from this group. Okay. Then you have group two. Group two is the people that want to change something. They know there's a better way of doing things in life. There's a better way to build wealth. There's better ways to create generational wealth. And these are the individuals that take action. When they see something, they understand, hey, my mindset might not be quite there yet, but I've got to get into this. I understand that there's something different. I understand that people who are doing things that I want to do are doing things differently. Because if I keep doing the same things, I'm going to get the same results. So they want to do something different. They want to have control of time, of their money. They want to live with purpose, as an example. Okay. That's group two. Group one, by the way, I wish this was the one where he's beating his head against the wall, because that's what happens. You go in it alone, you try to figure this stuff out, like I did, by the way. I took about 3 years and I traveled around. I flew to infinite banking practitioners' offices and learned directly from them. So that's how I did it. That took a long time, a lot of money. Okay. Go it alone or group two. Group two is really, guess what? Hey, I want to learn more about this. I understand the power of infinite banking and I want to see how it can work for me in my life and my family. So let's hop on a call. Let's talk about what we're trying to solve. Let's talk through your questions and let's see if infinite banking is a fit for you. That's it. There's no sales pitch. There's nothing to buy, none of that kind of stuff. These calls are essentially a strategy call to see, okay, what can we do here? Does it make sense? What can it fit with you in your life? What can it solve? That kind of stuff. Okay. So that's really what that is. Now, so guys, that's it. That's my last slide right there. But I like to end on this one and then we'll answer some questions. But this is a fun one. Once again, the problem in America isn't so much what people don't know, it's what they think they know that just ain't so. So let's kind of, if you guys have any questions, let's go through those. So I see a question from Derek. He says, do they deny or accept you based on health screening for whole life? Yes. Yes. And so Derek, oh, I have my screening in the morning. Well, yeah, Derek. So what you would want to do is, and this is what I do before mine. So I go vegan if possible. I cut out sugar, sodas. I don't drink this stuff anyways, but I cut out all that kind of stuff. I eat very healthy, cut out anything that's high in cholesterol, and then I fast for 18 hours before the exam just to kind of get everything out of my system and clean myself up. So there you go. Douglas said, why are the recaptured payments put in a segregated account begin used annually rather than being used to pay down the other debts? So Doug, good question. So what you can do is put them, you can do that too, by the way. There's lots of different ways to cash flow it, but we optimize it the best way. So what we typically will do is have them go into your policy loan. So you could have them go into other debts, or you can have them go back into your policy loan, which then reduces the amount of interest you're paying on your policy loan over that year. So it can be one or the other, by the way, but when we do the debt mapping, we find out the best way to do it. Yeah, so there's no like right or wrong answer to that question, but good question though. Cragen said, if you can only pay a capped amount monthly towards your whole life policy, what does it mean to pay back the loans from the policy with interest? So it depends on, so you have to look at your cash flow, to be honest. So that's where we say this has to make sense. And I'm not going to sit here and say that this makes sense for everybody. I will not say that. Okay. So you have to look at your cash flow. So when we hop on a call, I would go through, or we would go through your cash flow situation. Where's money going? Where's it coming from? That kind of stuff, and see if it makes sense. Because oftentimes what you're thinking about right there is expenses. Expense this, expense that. But it depends on also what you're doing with the policy loan. So as an example, let's say you have a policy going, or you have a policy in place, and you borrow against it, and that policy loan goes into an investment, and that has cash flow. Well, that cash flow would come back and pay back your policy loan. That's an example right there. If you're paying off debt, as an example, depending on how much of debt, the debt cash flow that was going to the creditors can now come back to that policy loan. So a couple different ways that you can do that. So, but yeah, it just has to make sense. Joe said, thank you. I did have step away a minute or two. Couldn't figure out how 25K was being deposited. I only make 35K per year. So that example, that's a doctor. So that doctor had like $500,000 of debt. So he lived a very extravagant lifestyle, I guess I would say, and had a lot of debts to do that. So keep in mind, it's just a fit for you. So take those numbers and remove a zero potentially, right? It's just going to depend upon your situation and how much cash you have and what you qualify for. Is debt part of what could disqualify you? No, Abigail, no. So debt doesn't disqualify you as long as the debt is being serviced. So what I mean by that is, as long as the debt is being paid on, it's not in collections, not outstanding like that, then the debt does not qualify you, because they're not looking at your credit report. They're just making sure that you're being responsible and making the payments. That makes sense. So yeah, so it does not disqualify you. You've got to look at things like bankruptcy. If you've had a bankruptcy in the last 12 months, and that can be an issue, that kind of stuff. All right. So another question just came in here. Early in the presentation, when talking about the machine and death benefit, you said you decrease the death benefit in the beginning in order to maximize the cash value. Yeah, it's a great question. So yeah, so what we do, if you go and get a traditional whole life policy, let's just say $1,000 per month or per year, whatever, just using a round number, $1,000. When you do that, $1,000 is going to go towards what's called base policy or death benefit. Okay. There's not going to be any cash value in the first year. Typically 3 to 4 to 5 years, there's almost no cash value. That's a traditional whole life policy. That's maximizing the death benefit. If you ever go to a traditional agent, they'll ask you, oh, you want to get life insurance? Okay, how much death benefit do you want? Like, that's not what we're doing here. Okay. So what we're doing is saying how much we want to put towards our policy and fund it. So what we do is we take that base policy number and we shrink it down so that only around anywhere from, 20 to 40% of the $1,000 is going towards the death benefit portion of the premium. And the rest is going towards, typically the rest of it is going towards the cash value. So it's a unique product with certain insurance companies. So not all companies have these same types of products. Some are better and some are not as good. So we work with ones that are they're proponents of infinite banking. They do have products that are specifically designed to allow us to do these kinds of structured policies. Yeah, so it's maximizing cash value or PUA or paid up additions. Terry says here, well, it makes sense to take the policy loan to pay down some of that. I only pay back, say, 50% on a monthly basis so as to reduce the stress to pay for daily living. Let me try it again. Would it still make sense to take out a policy loan to pay down some of my debt, but only pay back 50% monthly so as to ease the cash flow needed for daily living? It can, Terry, yes. So here's the thing, though, and this is a question I get a lot. Someone says, well, if I make, let's say, $100,000 per year, can I put all of that through the policy? No, you cannot. So you do not want to burden yourself and put yourself in a stressful situation or cash flow situation by doing something that's outside of your comfort zone per se and putting too much towards something. Doesn't matter if it's infinite banking or some other vehicle. You want to make sure that you have that cushion there with cash flow to make sure that your basic expenses are covered. But yeah, typically the amount you would put towards a policy based upon, let's just use gross income as an example, is going to be anywhere from 15% to I think 30%. So it's never going to be typically more than that unless you have a lot of liquid assets, then it can be more. But something I don't talk about in this presentation, so I mentioned the $1,000 going towards this per month. Is that the minimum you have to pay every month? No, it's not, by the way. The $1,000, you can pay less if you have a situation and you've got to reduce it down to like maybe 50% or 40%. You can do that. That is an option. You don't want to do that long term though, but that is an option. So, and additionally, the other question I get is, am I going to be paying this premium deposit for the rest of my life? No. In the example of the debt that I gave you, or the other policies you saw there, I gave some examples. I show the premiums dropping down significantly after you're 7 or 10. And they can go to 0 if you want, by the way. So they're flexible. So yeah, so these are not lifelong things. You can actually drop them down. And then why would you do that? Well, they're very efficient. Additionally, when you drop them down, you can also then take that cash flow that was going towards the premium and do a second policy. So other ways to do it. So they're very, very flexible. And that's why we always say that these are built for the individual. They're not cookie cutter. It's not the same for everybody. Okay. So there are different factors, things like that. So good time. Good question. So after someone graduates, by the way, graduate means going up into that place in the sky, hopefully not down below, but you never know. But yeah, so when you graduate or pass on, the policy does not continue. Now, there are options in the policy where the beneficiary can choose to have the death benefit rolled into some other vehicle with the insurance company, but the majority of the time, the beneficiary is going to take that policy's cash value as, income, or not income, but it's as a cash lump sum. Yes, great question, Glenn. So this is kind of the cool thing. This is why the insurance companies do this. So let's say you have a $500,000 death benefit and you have a $100,000 loan outstanding and you pass on, you die. The death benefit would be paid out less the outstanding loan. So in that case, 500,000 less 100 would be $400,000 paid out to the beneficiary. And then Gloria, yeah. So when you graduate, the policy matures, they call it. It's done. So it can't continue in the same form. No, currently right now, the death benefit is not taxable. That's not taxable. That's a huge benefit, by the way, of infinite banking. So because you think about this, like think about it this way, and this is with a client I'm working with right now. They have $1.4 million in a qualified retirement plan. Okay, they're in their early 60s, and they're saying, well, what happens if I pass away when I'm 75 years old? Okay. Well, that qualified plan, there's going to be estate tax. It's going to be liquidated. There's going to be taxes on that, all this kind of stuff. I'm not a tax attorney. Keep that in mind. I'm not your tax attorney. And this is not financial advice. But what happens is there's going to be something's going to happen. But now that individual is saying, well, wait a second. If I take the money out of my qualified plan for the next, 5 to 10 years in big chunks, and I pay the taxes today on it, put it into a policy, and let it start to grow and compound, and then invest that money, and then down the road, that money's passed on. Well, it's grown by quite a bit more than it would have inside the qualified plan, by the way, potentially, and is passed on tax-free. So they're saying, well, wait a second, if I pay taxes today, and then it's passed on tax-free, all of a sudden the math is like pretty powerful. It's pretty amazing. Yeah, but keep in mind, it does not make sense in every situation. That's why we hop on calls and go through that. But it does not always make sense. But this clients, they're looking at the math and saying, holy cow, because generational wealth is a big deal. And they want to pass that money on, but they don't want, they want as little money going through their estate, right? State tax, all that kind of stuff as possible. So they're going to funnel it through infinite banking so that it's passed on tax-free. Now, here's the thing. There's another way to do this. Derek, you beat me to it right there. How do I take policies out of my kids? So it depends on the age, by the way. So the way we typically would do this, if you have the income and you want to start doing policies generationally for generational wealth strategies, you start with the patriarchs of the family. So think of like mom and dad, okay? Maybe they're in their 50s and their 60s. They have adult kids, okay? You get them insured first. Now you've locked in that generational wealth for that second generation. Then you open up policies on the next generation, your adult kids, where you can be the owners. Okay, so there's 3 people involved in a policy, by the way. You have the insured, that's a human life, has to be a human life. You have the beneficiary, that can be a person, like kids, the next generation, or it can be a trust, by the way, too. Then you have the owner. So if you have insurable interest on your kids, you can get a policy on them, okay? Depending on the age and that kind of stuff. And your trust, by the way, could be the owner of the policy and the beneficiary. That's, by the way, how some of the big families do it, is they have trusts that own the policies and are the beneficiaries. So, but yeah, that's how you can do it. So with kids, we just hop on a call and go through it. It's pretty simple. See, Jimmy says here, if you use a 401k loan to fund a policy, does that mean you have to pay back both the policy and the 401k at the same time? If so, how would that work? Great question, by the way. Great question. So yes, you can do that. Once again, caveat to that, it has to make sense. Cash flow wise, it has to make sense. But what you do when you do that is you're essentially, when you borrow from the 401k to do the policy, typically you're borrowing from the 401k to do the dump-in, not the ongoing premiums, but you're doing the dump-in, okay? And what you're doing by doing the 401k loan is you're funding the dump-in, okay? So typically the dump-in is done with cash. You have cash lying around, you have a qualified plan, you're borrowing, you're taking money out of that, liquidating that, or real estate deal, cash is out, you take the money, do a dump-in. With a 401k loan, you're creating a loan that you're going to want to pay back in the 401k into the policy. So yes, you're going to want to pay back both the 401k and the policy loan, but you control the loan payments. So it depends on how much you're taking out of the 401k. You could choose to not pay back the policy loan right away, pay back the 401k first, maybe only pay the interest on the policy loan so it doesn't, compound on top of itself on an annual basis. And then you take the cash flow once the 401k is done, then you take that cash flow and put it back into the policy loan. Okay. That's a good way, long-term thinking, by the way. It's a long-term way to think about the dump-in. So good question though. Yeah. And by the way, we do have people doing those. Yes. So it's, I've done that many times. Absolutely, Gina, not a problem. So guys, so I know we went a little bit longer than expected as always, because I love this and I love the questions. So any last minute questions before I let everybody go? So Phil, great question as well, by the way. I love these questions. A dump-in can only happen or occur when you open the policy. No. So The short answer is yes, that's the simplest way to do it. But if someone says, hey, Brian, I have like a $30,000 thing that comes in every year. Can I put that in every year? There's a couple ways to do it. So with one company, we can build it to allow a dumping to occur multiple years. Okay. Now here's the thing. I always kind of, not a warning about that, but you got to keep this in mind. If you're going to do that, you've got to be certain that you're going to be able to make that dump in the following years, because it's like when you build the policy to accept those, it's like having a bag that can hold 20 pounds. Okay. So if, and let's say you only put in half of what you thought. Well, now you've got a 20-pound bag that cost, a certain amount of money, but it's only got 15 pounds in it. You want to make sure that you put 20 pounds into a 20-pound bag is my point. So yes, we can, Phil, by the way. So yeah. All right, guys, any other last minute questions? Curtis, likewise, I look forward to it as well. Gary, is the growth and removed money tax-free? Yes, depending on how you remove it. So here's the fun thing. So the growth inside the policy grows tax-free. The loans are tax-free because a loan is not considered taxable, okay, because it's obviously going to be paid back. That's the thinking right there, right? The only time that something would be taxable is if you cancel and close the policy prematurely. It's called surrendering. When you surrender a policy, you get your cash value out of the policy, by the way. So keep that in mind. You don't lose your money. Like within a 401k, you put it inside there and it goes to zero because the market crashes, money's gone. Put it into another like crypto, and it collapses, money's gone. With these ones, there's guarantees. It's going to grow. If you surrender it, you get the cash value out of the policy, and then any gains are taxable. So gains would be taxable at that point in time. Like the 5% dividends, that kind of stuff would be taxable. So yeah, good question though. Yeah. And then Phil, so if I open up a policy with a 40K dump in, then set up the policy to just then put a 10K in per year, I obviously wouldn't need to have the 40K each year. Exactly, correct. Yep. Now I do have people though that say, hey, I want to do a premium deposit of X 10,000 per year, and I want to put in 30 on top of that every year as a dump in. Now we can do that. You have to qualify for it, of course. It's like anything else. You got to qualify for that. And but the reason why people would want to do that is because one, the dump in is optional. You don't have to do it. You're not locked into doing the dump ins. Okay. But also 90% of those dump ins go to the cash value. So you get a lot more cash value with the dump ins, but they're typically going to be larger amounts of money. So, but yeah, great question though. But yeah, we do have people that do that, but it's not common that people are doing multiple ones, because what you can also do is do a second policy. So you can stack policies. It's called policy stacking. You can have more than one policy on you or on other people. So we have people like I don't remember how many Steven has. Steven, how many do you have? I don't remember how many he has. I have a couple. Chris Naugle has like he has 4. Chris, I think, has like 16 or something, like 17 now. Devin has, I think, 13. Nelson Nash, when he passed away in 2018, Kessler has 24. Brent Kessler has a lot. This gentleman had like 40 or 50 or something. This is the gentleman that started this concept. You have to qualify for them. Okay. Keep that in mind. You got to qualify, and it has to make sense. But a lot of times that's why people they want to stack policies, because the reason why you would do this, yeah, like I like that example that Chris and Stephen give. It's like opening up additional branches. So when you go to, like Seattle or New York or something like that, you're going to see multiple Bank of America branches or multiple Chase branches. So when you open up one, you max it out. You can't take any more clients, do a second branch. So that's kind of the way we look at it. And so as your income goes up or your cash flow increases, you can do second policies or third policies. You can also do them on, as we said, other people. If you don't qualify, oftentimes you're doing them on spouses, on adult kids, things like that. So pretty versatile, pretty versatile. Good questions though, guys. I really appreciate the questions. Building my banking system. Exactly. All right, guys. Any last minute questions? By the way, I'm going to hop on a call here in about 5 minutes with someone else who wants to learn more about infinite banking and get it in place. So yeah, appreciate it, Doug. No problem. Douglas. All right, guys. With that, I appreciate all of you. Appreciate you guys being here. And we do have a lot of ongoing education. We do have a lot of ongoing presentations we do. So if you guys want to hang out with us tomorrow, we have Ask Me Anything at 4:30 Eastern time. You can find it on Chris Naugle's YouTube channel, and we live stream that. And so you can come on there and ask any question of myself and other agents. We have the Wealth Wednesday webinar on Monday mornings. We have the WTF on Mondays, I think it is. Yes, yeah, that's at 9:30 Eastern time, and I'm gonna actually be doing that one. I think next week I'll be doing that one as well. So yep, yeah. And any suggestions on the presentation, let us know. If you have anything you think would be a good add addition to it, yeah, let us know. We always love to update these presentations. We're always tweaking them, by the way. So, all right, guys. So with that, have a great rest of your Tuesday. Have a safe rest of your week. And for some of you, I will definitely be talking to you soon. All right, take care, everybody.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.